Good afternoon. Welcome back to another Hoya Capital webinar. I'm excited to be joined by Carl Whitaker from RealPage. A little bit background of Carl. He is the chief economist at RealPage. He's in their analytics division, focusing on apartment market commentary. Now, we may ask him to get a little bit out of his comfort zone today with Road to Housing Act, single family rental REITs, what's going on in the world of resi in general. Carl's based here, or has spent a lot of time here in my backyard of Dallas, and went to North Texas. Big fan of the Mean Green, and an aspiring DJ. So we're going to call him DJ Whit maybe today at some point.
I like it.
We have way too many slides to go through, looking at quarterly results, multifamily demand, geographic demand, and looking at performance. So we've got so much data here that we'll be able to go through. If anybody's interested in this presentation, feel free to hit us up. Carl, we'll go ahead and kick it off here. Like I said, I don't want to have the slides up the majority of the time because I want for us to have this conversation. But there's
Sure.
just so much good visual data here that we've assembled. Um, I don't even know where to begin. So let's just kick it right off here. You have this slide that says early 2026 data suggests the confluence of steady demand and easing supply is translating to gradual improvement in key apartment statistics. Now, coming out of the big REIT conference a couple of weeks ago in New York, you had many of the multifamily players kind of echoing that sentiment. Are we where we were coming out of COVID or in COVID? Of course not. But it seems like that we might have finally seen some of this start to turn towards the positive. So, Carl, why don't you jump into this? We'll walk through maybe some of the quarterly slides. I'll turn it on and off as we go through it. But hopefully you'll say some stuff and I'll warrant some back and forth dialogue for us.
Yeah, absolutely. No, I appreciate the intro there and the background on some of the conversation coming out of the REIT conference because I wasn't able to make that. And it's interesting too because I'm sure many of y'all are at least aware of, if not actively following Jay Parsons, and I think he and I kind of in the apartment market prognosticator space, if you will, we've kind of shared the same view that demand hasn't been the issue the past couple years. There was a brief period in late 2022 where that was the exception, but I think some of that was just kind of coming out of that post-pandemic noise, just really a kind of a resettlement period. Since then, we've seen that demand has actually been quite strong, but to nobody's surprise, it's really been supply that has rightfully so taken the lion's share of the narrative. And that's been true certainly in the Sun Belt, but there have been, of course, some gateway markets where that's been the case. It's really been basically the Midwest where that story hasn't held as true. And perhaps unsurprisingly, then it's the Midwest that has kind of been the quiet, slow and steady moniker throughout the past couple of years. And looking at this particular slide right here, candidly speaking, amongst the folks listening in, I was actually surprised, also encouraged to see that first quarter absorption number not only outpaced concurrent supply demand, or I'm sorry, Econ 101 just simply says, hey, when that happens, that tells you that theoretically rents and occupancy should start moving shortly thereafter. But I think the bigger thing was that we kind of corrected course from what we saw late last year, where demand actually did hit a little bit of a short hiccup. And I think had we seen demand remain soft in the first 90 days of this year, we would have since changed our narrative to saying, hey, something is wrong with demand. I think in retrospect, what we saw late last year was uncertainty, political uncertainty, economic uncertainty, really kind of cramping consumer sentiment and therefore putting the dampening on demand. Since then, that does appear to be working mostly out of the system. And I say mostly with an asterisk because, of course, we still live in very uncertain times.
So here's the story that you were talking about supply as it has started to kind of trend here a little bit. And then we look at effective rent because I think that's a very noticeable statistic that jumps out, especially when we look at, call it, new versus renewals, because you mentioned Midwest, and I always like talking about the Midwest because it seems like those renters are more sticky than what we would traditionally see here, let's say in Dallas of all places. So when you're in some of these more sticky markets, it might inflate the numbers a little bit, but the key is the fact that those tenants are signing those renewal leases. So maybe you could walk us through where we stand on this effective rent story as well as the rent growth picture. And also, more importantly, this is very timely because, as you know, and maybe a lot of people that are listening to this know, right now is what's considered prime apartment leasing season, right? So, this, whether it's apartments, single family rentals, student housing, et cetera, this is prime leasing season. This is what all the companies get excited for. Now, one point to note, though, traditionally it used to be like a 3 month picture, right? May to June, June, July, August was prime leasing season. And now that's kind of been extended out a little bit. It's a little bit, let's say, longer. It's not a 5 month process. We'll call it, let's say, a 4 month added process in here now. But what are you guys seeing, let's say, without revealing too much of what's to come here, but what are we
Mhm.
seeing early signs of prime rental season right now?
Yeah, yeah, for sure. No, and I'll just sidebar real quick and say I'm glad that you mentioned that on the let's call it continued disruption of seasonality. Things do seem to be more normal than they were certainly 6 years ago or this time 6 years ago. But still, I think when we look at that normal peak leasing season, while this is still certainly the peak, it's not as clear cut as it would have been, say, 2018, 2019, in those pre-pandemic times. So I'm glad you mentioned that just because I think that is an interesting little, just an interesting quip to add. So the chart that y'all are seeing here right now, looking at quarter over quarter change in rents, this is going to be the advertised rent. So advertised rent minus any concession being offered. And despite the concessions that we see out in the market, we're still seeing that those base effective rents are getting a little bit of growth in the first 90 days of the year. We called out 2011 to 2019 just kind of as a hey, last cycle baseline. And I'm sure that this gets echoed on a number of the REIT earnings calls as well. But most of the country isn't back to that 2011 to 2019 baseline. However, that isn't to say that we're absent of any growth in the first quarter of the year. And again, that kind of corrects course from that 2023, 2024 window where that wasn't the case. Now, the other thing that I would mention too, which isn't in this deck, but in reviewing some of the preliminary monthly stats, we saw that both April and May slightly outperformed the same time last year. So if you get into a momentum discussion, there is a little bit of momentum building. Now, in all fairness, it's not much more than a rounding error. But still, when you start talking about momentum, just simply replacing a small number with a smaller number from the period prior, that is a form of momentum. And I think the market is starting to see that. Now, on the year over year stats, one of the, as many of y'all know that work with the data, one of the downsides of year over year is it doesn't always show that in real time. So year over year, we are seeing that rents are still down on that trailing 12 or year over year basis. But I think early this year has shown some positive movement. I also think too that going back to the point on peak leasing season, what we really are going to pay close attention to here in the next couple of months is what happens in the early half of third quarter. And the reason that's going to be important is it was third quarter last year that we saw kind of that bizarre evaporation of demand. We saw that on a sequential monthly basis, rents were being cut month over month in a number of markets as early as June and July. That's basically never happened, or at least I should say, never happened outside of recessionary windows. So again, if this year can maintain even a tiny bit of stability, that's going to inform some of that momentum improving year over year. And then some of that too also just comes off the heels, and I'm going to sound like your Econ 101 class in college again. Some of that comes off the heels of just simply moving past peak supply, not only in terms of nominal value, but in terms of also the distance or timing at which we've moved past the peak. There's a number of markets that are now as far as 8 quarters away from that peak supply. There's only a handful of markets that have yet to hit peak supply, which we can talk about that in a little bit. But again, I think the timing of, if you look at the demand data, you look at the supply data, demand holding firm, supply starting to look much more cooperative, that altogether informs the story of improvement. It's very, very, very gradual. I don't want to overcharacterize significant improvement, but there does appear to be that genuine improvement in the performance stats.
You briefly said the word concessions, and you have this great slide talking about concessions in the first quarter. Now, I know it's changed today than it was, let's say, a quarter ago, meaning the concessions may not be as favorable as they were just a few weeks ago, seeing that there is that improvement. But from a very high level, what kind of concessions were we hearing about? What were you seeing? Maybe where do things stand in the current environment?
Sure. Yeah. And I think concessions, for what it's worth, I think that's going to be the topic du jour, or one of the top three topics du jour on this next round of earnings calls. Just, exactly that. What are you seeing change in the concession environment? Nationally, we're seeing that concessions are being offered at basically their most frequent rate that we've seen in over a decade. And, again, that just kind of speaks to the volume of supply that's delivered nationally. Now, when you start breaking this out by asset class, I would actually personally say that this is where the devil is in the details, so to speak. The national numbers as a first quarter show that about 1 in 4 units is offering a discount. But if you look at where those discounts are being leveraged, it's substantially skewed towards Class C inventory. And I think the idea there is that demand, that's the one segment of the market where demand actually is an issue. And we could talk about why that is. I would offer that it's affordability driven. I would offer that it's immigration policy driven. I would offer that it's partially driven by some of the weakness in some of the economic sectors that inform that demand base. There's a lot of different angles we could take there, but nevertheless, the end result is that Class C, which, by the way, just methodologically speaking, RealPage is defining that as roughly the 25% most affordable units in a market, not capital A affordable, but that would be your lowest quintile of market rate rent. Think of that as your attainable housing. Class A, on the other hand, is going to be your top quintile of properties based on that average effective rent. That's going to be your brand new stuff, your downtown stuff, your highly amenitized stuff. That's really going to be more of the REIT and the institutional space, if you will. A little bit of bleed over into Class B, but largely Class A. The reason I say all that, though, because I know that's a lot of boring methodology, the important takeaway there is that on the Class A space, we're not seeing concessions being leveraged as frequently. And my read on that is that, again, the demand base that informs Class A demand is actually holding on really well. Where we do see concessions becoming a bit of a headwind is in terms of the depth of discount being offered. In other words, if you see a 2 month concession being offered, chances are it's probably going to be in that Class A space. And the reason for that is that when you get into some of these high supply markets that have had so much inventory delivering, you're just competing with a big slew of properties that are working to reach stabilization. So Class A, the demand looks good, the supply is becoming more cooperative, but it's a more competitive environment based on how much supply is delivered. Class C, concessions are being offered in an attempt to stimulate demand. And I think that's why it's important to differentiate the A, B, and C sectors today, even more so than it was last cycle.
And as you mentioned, the REITs obviously in the Class A, maybe bleeding into the Class B. And I always like to tell people when we have this conversation, whether they're leveraging RealPage data, Yardi, CoStar, pick your favorite data provider that's out there. These players know to the unit level what the number is, meaning we know what we can charge. We know what the guy next door is charging. We know what the new property a half a mile down the street is charging. They are so in tune with what's going on in their general surroundings. That's kind of hard to have, call it pricing power, when you've got Class A across the street from Class A, and they're basically bumping up against each other when it comes to, what kind of concession and terms, because they're basically being negotiated against each other, right? So you have this great slide here looking at fundamentals, and I think that's the
Mhm.
key. So no disrespect to the C players. I think we can kind of put that maybe a little bit towards the rear view mirror, but let's focus on the A and B fundamentals, what we're seeing out there right now.
Yeah, yeah, absolutely. And this is something that I know the REITs have really been kind of grilled on in the past couple of earnings calls is, hey, how much of a reduction are you seeing in move out to single family home ownership? I think that that personally is an important driver of some of that stickiness that we talked about earlier. And I'll share here too, one of the fun things as an economist is that oftentimes you come into a situation with a thesis, the data either supports or denies that thesis. One of the areas in which I've been extremely surprised, but also pleasantly surprised by, is the stickiness within that Class A renter base. In other words, there's not the turnover that you would necessarily expect based on whether it be concessions, based on whether it be Class A renters being priced out. I think you're seeing again kind of a strong basis for demand in that Class A sector. But again, I do think you are also seeing a prolonged renter life cycle because the gap between owning and renting a home is larger than it's ever been before. There's estimates out there that it's literally twice as expensive on a per month basis to own today than it is to rent. So I think that that's a big driver behind some of that strength in the Class A sector. I also think too, and this gets a little bit more region specific or a little bit more market specific, but again, looking at the economics of your typical Class A renter, generally further along in their career, generally higher earning households. That's the segment of the economy that has been able to weather weather the storm of inflation the past couple years better than the rest of the economy. When we talk about that K-shaped recover, I'm sorry, not recovery, the K-shaped economy, the part of the K that is pointing upwards is largely that segment of the economy that would be renting in Class A units. I think Class B a little bit more nuanced. It kind of depends on if you're on that upper end of the B spectrum or the lower end. I think the upper end probably is just by nature of proximity is going to be closer to the Class A trend. Class B minus is going to be closer to the Class C trend. I think something interesting to watch for what it's worth in the next 6 to 12 months is going to be what happens with that middle part of the Class B sector. Does that segment of the economy start showing financial distress? Does it start to show the pressure of weak job growth, or do we actually see that sector of the market continues to hold relatively resilient demand? Do we see that easing supply pressure actually does translate to some performance improvement in the middle tier of the B segment? So I know that's a lot of different ways that we can look at the data, but I personally kind of think that is the ABC, well, I was going to say dichotomy, but I guess it's trichotomy, a word, kind of the three differentiated components of the total.
What, what about looking at it? Let's start looking at it on a city by city basis here,
Mhm.
because you have a couple of, call it dot charts that you shared with us here, looking at MSA occupancy, what's lining up year over year, what's seeing rising retention. Which of these do you want to kind of jump into and what stands out to you here?
Yeah, let's start on this one if you're okay with it, because I think this right here is probably one of the more powerful slides in the deck. I think it actually captures a number of different angles that we could cover. But what you're looking at for those that are in front of the screen right now, this is looking at market occupancy inclusive of any lease ups in the market. Typically, we kick out lease up occupancy just because we don't want a property that's 5% occupied because it's been leasing up for 1 week. We don't want that to water down our reported occupancy figures. But we actually removed that parameter and said, hey, let's just look at any property, whether or not it's 5% leased up or whether or not it's 100% filled. And what we saw in doing that is this story again that really bears out by geography. And what I mean is that when you look at an Austin or a Charlotte or a Raleigh, no question there's been a ton of supply there. The data supports that. We see that Austin market-wide occupancy just 91% or so. I have no doubt that there are submarkets in Austin that are sub 90% occupied. When you start talking about where's the pricing power, or why are those markets cutting rents? Well, again, lo and behold, there's your answer. There's just the vacancy rates are so high. However, when you look at the y-axis, this reiterates that story that again, demand is not the issue. So I'm going to pick on Austin again, just kind of as the poster child for the development epicenter of the U.S. this cycle. Over the past year, Austin's total occupancy has risen by 300 basis points. So if I'm looking at that, I say, wow, that's actually pretty strong demand. It's just that that market has been met with something like 40% inventory growth in the past 5 years. But before rents start to significantly move, that occupancy rate is going to have to shift to the right on this y-axis. And that cluster of markets in the upper left is, again, the quintessential demand is not the issue, supply is narrative. I think the red markets highlighted there, which are going to be Dallas, Tampa, Orlando, and Houston, ideally, I would have liked to have seen a little bit more movement in occupancy over the past year. They still saw positive movement, so I think there is some of that demand strength still in place. But I do think those markets would stand to benefit from improvement in job growth, perhaps some improvement in inbound migration, even if it's not 2020 peak levels, just kind of seeing some more of that inbound migration starting to stabilize. And then finally, the last market I'll pick on here is Washington, D.C. Washington, D.C. was the only major U.S. metro that saw a total year-over-year decline in occupancy. And I think the story there is pretty simple. We know the economic challenges that the D.C. market's facing today. I'd have to look at the BLS stats, but forgive me if I'm wrong on this, but I think it's something like 7% job losses in the past year. Because of that, that's one of the few exceptions where, again, we have seen demand is the issue. I think it's short term, but demand has been the issue in DC over the past couple of months.
Carl, I don't want to pick on Dallas, Austin, Houston, and our Texas brethren here,
Mhm.
but when you talk about, the amount of supply that's come on and all that fun stuff, we're talking about cities that are very pocket oriented.
Yep.
And I think it's hard to compare an Austin or a Dallas to some of these other markets that are on the chart when you look at how spread out some of these cities are.
Right.
Call it in Dallas alone, 30 miles, north to south, maybe, with all the various submarkets around the tollway or around 75. You know what I mean? Like all these little different microcosms of a Dallas that are out there. And so some of these pockets might be absorbing that supply because that's where the renters are moving towards, or where the inbound relocators that are coming to Texas are moving into those sought after high demand areas. Whereas some of these other markets might be a little bit softer, though they're still in demand. They're just not seeing that wave of migration that some of these other pockets are seeing. Think about Austin, SpaceX, downtown, all of that stuff. Obviously, that's where people are going towards versus a few years ago, Round Rock was where everybody wanted to go to. Now Round Rock is basically almost fully saturated at this point, I would say. And so it kind of spreads that bubble further and further. It goes back to that home affordability conversation. Don't want to shift gears too much, but when people say, oh, I can't afford to live in Dallas, and I'm like, well, that's not true. You're not going to live inside the circle, but you can
Right.
buy or rent outside the circle and afford it. You're just dealing with a much longer commute to be in that central access, let's say. So I do feel like it's important to put a little asterisk on here, noting that some of these cities are so pocket oriented that that's where a lot of that supply has been delivered, because that's where the people have been moving towards. I went to University of Texas. I think about West Campus. Apartment occupancy there is obviously through the roof because so many of the homes have been torn down. They've been rebuilt with student housing or apartment style properties, and that's where people are living to be close to campus. So, I've seen that with my own eyes. How about looking at, we briefly touched upon it here, year over year, stabilized occupancy, looking at it city by city. You mentioned DC. I'm trying to find DC on this chart here.
In that lower
Got a
left
lot of
quadrant.
cities on this chart here.
Yeah, it's in that lower left quadrant, kind of an
There we
outlier there
go.
alongside
There we go.
Denver.
Um, so what can we share here? And we'll combine it here. Let's say occupancy versus retention, because again, I think that's one key thing here is we've heard for more than a year now, new leases down, retention up. You're showing here retention up, obviously, poor Seattle. But what can you share with us here?
Yeah, yeah, absolutely. So again, nationally, the trend is that most markets are seeing retention increase year over year, which again kind of supports that idea that the underlying demand base is strong. I've used this analogy a couple times, but if your retention is decreasing and it's being picked up as traffic, that's not necessarily a bad thing, but it might indicate that, hey, there's a bit of a musical game of chairs, or what is it, uh, 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 what's the game where you sit and like you have the chair pulled out, somebody's without a chair.
Musical chairs.
Musical chairs, thank you. Yeah, the musical chairs. If there's a lot of concession hopping and it's kind of this ephemeral demand, then that's one potential concern. But the data shows that that's not necessarily the case. What we're seeing is that retention is up and traffic is stable. So you actually do have theoretically some growth in the underlying demand basis. Now, there are a couple of exception markets. I talked about DC. I think it's a pretty simple story there. Just the economy has contracted so significantly. I actually think Seattle is an excellent microcosm, though, of the A, B, C nuance that we talked about earlier. So when we look at Class A Seattle, those properties and that the submarkets that are home to more of a Class A style property, those parts of Seattle are actually relatively stable year over year. What we're seeing is that Class B and especially Class C in Seattle is where most of the turnover is happening. And I think what may be happening there could be some doubling up beginning to happen. I think you may also be seeing that as a core gateway market and with lesser inbound international migration, you're seeing fewer new first-time people show up in those coastal gateway markets. But if you look at Class A Seattle, if you look at the REITs and how they're performing in Seattle, they're probably quite a bit better than what the overall market average is showing. So I think really what's happening there is that, again, you see the AI demand boom that's happening in like a San Francisco. Well, some degree of that may be happening in Seattle. It may not be happening to the same scale, but there is some kind of spillover impact there. Conversely, the lessened port traffic going into Seattle is supporting weaker fundamentals in Class C and B rentals. So I think that's actually a pretty good microcosm of the overall ABC trichotomy that we could quoted earlier. But again, I would point to the right of the chart and once more just reiterate that even in these Sunbelt markets like Austin, yes, retention is lower than expected in Austin, but it's improving year over year. And I think some of that also points to that idea that we're moving further past that peak supply period. I'm not going to deny that a Phoenix doesn't still have a lot of units coming online, but it doesn't have as many units coming online today as it has the past 6 to 8 quarters, and that's translating to some stabilization, let's call it, in the stats.
You briefly mentioned it. All hail our AI overlords in San Francisco. But it's interesting to see them on the completely other side of the chart here.
Right.
Is that because the retention is so high because it's a lack of new product that's come to market? It's just so unaffordable to own a house and rent a house that that's why the apartments are the winners? Is it the ABC story here? What's driving such high retention in San Francisco?
Yeah, it's a good question. I think it's a little bit of all of those things. I think also too, this may come down a little bit just to pure sample. Our data, excuse me, may be a little bit more hyper focused in the part of San Francisco that would be standing to benefit the most from the return to office narrative, the AI boom. I think if you get a little bit further outside of the urban core, even if you get outside into some of the southern San Jose submarkets, just for the sake of example, you see a little bit less of a robust narrative from that on that particular data point.
My apologies. I meant to ask this earlier when we were talking about it, and now I just
Hmm.
found the slide. But this was a fantastic slide that you put together talking about the concessions year over year. And I don't want to necessarily jump and look too much into TQ here right now,
Sure.
but would you say how much would you say this chart has changed if we had to look at it from today's eyes versus, let's say, a quarter or a year ago?
Yeah, it's a good question. I think the biggest, clearly on the right-hand chart, what stood out to me as the most glaring examples were Las Vegas and Tampa seeing a significant rise in concessions. My read on that is, again, those are two markets where the demand story did become a concern in the past year. And because of that, you've seen concessions try to catch up and stimulate some of that demand. I think in the next, call it 90 to, or I guess we're almost at the end of second quarter now. I think as we review the second quarter stats, I think we'll start to see some of those outlier markets start to normalize. I think we could see a couple of Sunbelt markets, such as Charlotte or I guess really more so Charlotte. I think we could see concessions go up a little bit just because that market supply tail is a little bit longer than some other metros like Dallas or even Nashville, which I think was shown on that slide. The markets that I'm curious about, and I don't know that I have a good guess yet, but I'm curious to see is there movement in concession offerings in Boston and especially that kind of northern New Jersey, Manhattan adjacent, what we call Newark, but it's really, the waterfront. I think we could see concessions increase in those two markets over the next 12 months, partially because, again, the supply tail there doesn't fall off to the degree that other markets have. But in Boston in particular, I think that's where it gets really, really hyper focused on where within Boston, because I think we are seeing that while parts of suburban to Boston demand actually seem okay right now, there have been parts of the market where impacts on immigration reform, impacts on policy adjustments have just simply affected, life sciences more in Boston, and that's going to show up more in the data. Maybe San Diego to some degree as well.
So let's take a step back because you have several slides in a row here that we're going to go through,
Mhm.
basically comping Gateway to Sunbelt. For those that aren't familiar, real quick, from where you sit, define Gateway versus Sunbelt. And then kind of let's start going through some of these charts because I feel like there's a lot of good data that kind of builds on itself as we're going through this, looking at those two different segments of the market.
Yeah, yeah, for sure. So Gateway Sunbelt definitions, admittedly more art than science, but we're going to consider Gateway San Francisco slash San Jose, Los Angeles, and Seattle on the West Coast. East Coast is going to be New York, Boston, and Washington, D.C. And historically, the defining factor for that was that those were the markets that had the most recognition internationally. Those were the markets that tended to be a little bit more liquid, and this is going back a couple cycles now, but that was kind of defined as those core investment tier one markets. Sunbelt here for our purposes, we're going to consider Phoenix, DFW, really, let's call it Phoenix, Texas, Florida, Atlanta, the Carolinas, and then we throw in Nashville.
So kind of the smiles they like to
Yeah.
say as well.
Yep. Yep. So it's gonna be that smile state. And I like this map because it does a good job of highlighting those differentiated pockets within the country. And we'll talk a little bit about this on some of the next few slides. But the Sun Belt story is again pretty clearly here. That's the coolest part of the heat map, meaning that that's where the rents are declining. That's then the epicenter of that supply boom. The gateway story gets a little bit more nuanced, cool in SoCal and in the Pacific Northwest, but the Bay Area is red hot right now. The East Coast, New York, kind of the red hot spot on the eastern side of the country. DC, or I guess Boston, and to a larger degree, I should say DC, tend to be a little bit softer, but still stronger than what's happening in most Sunbelt markets.
It's interesting to see DC and your NorCal charts, how there's again that wide disparity here, looking at the effective rent change. Again, I feel like it's pockets, it's pocket oriented here that's seeing that big jump. But let's follow it up here because again, like I said, you have a good run of slides here that compare Gateway to Sunbelt looking at a lot of those MSA areas here. So let's talk about this one right here. And of course, there's the definition that you guys use. Thank you.
Yeah. Yeah, of course. Yeah, I wanted to add that in there in case any questions come up. But yeah, in putting this chart together, I really kind of had three. I'll try to make it somewhat brief, not always my strong suit, but three brief takeaways. One was going back to 2016, 2019, kind of that pre-COVID baseline. Not a huge difference between what was happening performance-wise in the gateway markets and the Sunbelt markets. I think back to that time, and it's funny because we were really splitting atoms when looking at the difference between those growth rates. Well, since then, we've seen that there's been a bigger disparity in performance. Obviously the slower recovery in the gateway markets, but now the more prolonged contraction in the Sunbelt metros. Again, it's supply demand 101. Sunbelt's just simply been the part of the country that's been supplied more heavily than the gateway markets. The other thing that I'd like to add here too, though, is that if we were to layer this on with an ABC story, while the geographic narrative is largely different, the asset class within those geographies, that narrative isn't all that different. And, conventional wisdom would say, hey, it's going to be Class A Sunbelt that's hurting the most right now because of all that supply. Class A Sunbelt is actually outperforming Class B and Class C. It's because we're seeing the stronger demand in that subset of the data. So I think it's important to note that geographic disparity is large, but those asset classes are holding fairly consistent themes regardless of geography.
One, I guess one question I would have though
Mhm.
is if I could take a, let's say, a B in San Antonio,
Mhm.
put that whole property on a flatbed truck and move it to Milwaukee, that suddenly becomes an A in Milwaukee, right? So it isn't necessarily an apples to apples comp because what's a lower quality in one city might be considered higher quality in another, right?
So the way we're defining it, it is both nationally aggregated and market aggregated. So the idea is to kind of control for some of those differences, but you do have what you're saying there is still valid that like functionally Class B Nashville is still going to be, and I'm making this up, but it's still going to be a 2011 vintage that is your podium wrap style property that isn't that old. It's just that so much has been delivered here recently that there's more new inventory that functions as Class A. Class B in Milwaukee is probably functionally more, as you're mentioning, your 1980s, kind of what we all probably think of as Class B. That's going to be more true in those markets. So there is a little bit, it is controlled by market, but yes, there are going to be functional differences between those product types.
Boy, a city that's jumping out my head hearing you tell that story is I'm thinking of Costa Mesa in California, which is a
Mm-hmm.
suburb in Orange County. Because like I think about where my grandparents live, where my father grew up in 1950s era apartments that still are in existence today, with the 2-year-old property that's right across the street. Both are basically fully leased up, and I don't know what the rent difference is in the two properties, but my guess at the end of the day is probably not that far off from each other, considering. I should look into that. Um, so we talk about cumulative rent change here. I think this is a very important number here because, again, at the end of the day, when it's all said and done, rents are up. I mean, there's just no other way
Right.
to slice and dice it. By the way, with mostly fully occupied properties, right? Anywhere from
Right.
93 to 97%, give or take, right? So it seems like the renters absorbing those rent hikes and filling up the properties.
Yep, and we see rent to income ratios, especially in the REIT subset of the data. Rent to income ratios are very healthy. It's rare that we see outsized rent levels relative to incomes, so the risk there seems to be quite small. And sorry, it
And
looks like
and
you had a
not to cut
question.
you off, but one thing to note is that
Hmm.
a lot of these companies, when they report, they do a very good job of talking about how much the average renter earns,
Hmm.
the pre qualifying process that that new rentor has to go through just to qualify to be able to live. And so it seems like a lot of these companies are being very stringent looking at
Yep.
that prospective tenant to see, can you cover the monthly rent? Can you cover it for 3 months in case something happens? How solid is your income base?
Yep. Yep. And again, our data echoes that where rent to income ratios nationally about 22% rent to income. If you go back to the very end of 2019, you know what the number was? 22%. So it shows you that even with some of these big rent growth periods, the pace at which wages have grown has largely kept up, not always exactly matching on like a quarterly basis, but and again, I think this is where Jay Parsons has done a really good job of echoing this idea is that wage growth, especially for this subset of the market, has been quite strong.
Jay appreciates the second reference. I'll make sure that he knows about
Yeah.
that. All right. Let's ask some broad level questions here. Okay. So I want to take a
Yep.
step back because obviously it's not necessarily apartment impacting, although I still think it does. But the big news is about this pass of the Road to Housing Act. Okay. And I was chatting with a single family rental REIT yesterday who's a little nervous about what's going on, but at the end of the day, this SFR players are saying, look, we're giving our renters an opportunity to buy this house. We have a path for them to be able to buy this house. So we feel like we're going to be insulated from this. We at Hoya have long said, though, that there's still a fundamental problem here with housing affordability. Lack of affordable product, mortgage rates elevated, supply demand imbalance. The data points right and left. And I don't think the announcement really changes home affordability since a lot of this happens at the local level. It may change some development angles with it, especially with manufactured housing. And we haven't really talked about manufactured housing at all. But from the apartment's sake, let's say, what is your thoughts about what's happening in DC right now and the impact on the apartment sector?
Yeah, I'm glad you asked. And I don't know if funny is the word, but I did see right before we joined our discussion here that it sounds like Trump is not going to sign and let that go to the next, not let that bill fully through. And it sounds like there may be another stalling of the Road to Housing Act. So your guess is as good as mine as to how much further this gets drawn out. I think the good news is, from what I've been seeing, is that this is, arguably one of the most bipartisan agreed upon. After some of the amendments have been made along the way, of course, one of the most bipartisan agreed upon bills coming through Congress in some time. I think for apartment owners, I think the thing that I would really keep a close eye on is, you look at the timeline to develop properties, a property going through permitting, construction, lease up, stabilization, a hold period, disposition. We can kind of table that part for now, but those first 4 or 5 parts of that property life cycle, how many properties have made it through the first 1 or 2 stages in the past few years, permitting and entitlement, but never actually broke ground, never actually have got to the point where they've started to get shovels in dirt and turn that dirt. If we see some of those planned properties now start to come to fruition, do we actually see the supply pipeline turn up a little bit more? Do we see do we see the delivery pipeline start to turn back on a little bit quicker than initially prognosticated? I think that is a potential outcome of this for the apartment space in particular. But again, I think your comment there on pockets earlier is really where the answer is going to be, because this is going to be so hyper localized. Even though it is national legislation, the ability to push through some of these new developments, for example, is going to widely vary based on where you're at, not only within the country, but within your specific metro area. And we're talking down to, street corner level, splitting the hairs here.
Apartment REITs have been in focus in the past year and a half, especially on the M&A front. Blackstone acquired Air Communities coming out of COVID. We see Aimco winding down. We see Elm Communities winding down. But more importantly, in the past few months, we've seen both Avalon Bay and Equity Res announce their merger, and then Center Space in the Midwest, exploring strategic alternatives, and then pulling that and deciding to sell about $250 million worth of properties. So there's a lot of different data points in the world of apartment REITs to touch on, but I think the biggest one is the Avalon Equity Res merger. What's your take there, and what implications do you think it has for the other publicly traded REITs?
Yeah, so I'll start just kind of by talking apartment world holistically. I think that there's, some uninformed fear that this is going to be a consolidation of, some of the biggest owners that will somehow suddenly inform, a monopolistic ownership of properties nationally. If you look at the share of those two REITs in any market, any sub-market, certainly nationally, it still informs a relatively small share of ownership of the total. So, the merger of those two owners there, it is certainly newsworthy, but I don't think it's going to move the needle in terms of national performance the way that it maybe gets prognosticated or shared. Prognosticated is not the word I'm looking for. The way it gets shared in media. I do think, though, that where I guess, and I'd be curious to get your thoughts. I don't know if I have a good answer on this. I think what is interesting to note is that I think back to 10 years ago when I was focused a little bit more specifically on the REIT space itself. There's probably five or six REITs that have either merged or have gone private in the past 10 years. I think at one point we probably had about a dozen that we could compare to in terms of publicly reported data. Now that's dwindling to, and keep me honest here, six or seven. I don't know what the exact number is. So in terms of just the REITs, what it means for them, I think it means that having data to compare to in terms of again the data that gets reported publicly the way that it was through 10Ks and through those earnings calls, there's just going to be less data out there to compare to. So I think that you're going to see kind of a shift towards trying to assess data through other lenses because that lens at which you're historically looking through is just becoming smaller and smaller.
So Green Street used to have a great chart. Unfortunately, I don't have it handy to pull it up, but talked about all the consolidation in the apartment REITs and how this person bought this, and here's where it stands today. We still have too many publicly traded apartments. So that's when it's all said and done. The universe is still very big. I don't think the Avalon Equity Res merger leads to, let's say, Mid America and Camden getting together,
Mhm.
but it would make sense. I can see it. I just don't think it's going to happen. So I think it's something to note, especially when you look at, again, Center Space taking themselves off the market, obviously not getting the bids that they were hoping for, or maybe piecemealing asset sales might be a way to unlock value more than selling an established platform versus like what Avalon Equity Res is going to do. Because at the end of the day, I'm sure there's going to be some asset sales there in that combined entity as well. And don't forget, we've also got Blackstone. They've got properties that might be coming back to market here soon. So, I mean, it's a market that's very ripe for transaction activity. There's no question about it. All right, let's talk about you guys. What sets RealPage apart from your peers? What makes you guys unique?
Yeah, I think one of the biggest things is the depth of historical data, and this is where I feel like there's almost in my world of data analytics, there's almost an embarrassment of riches in some ways because we do have just such a rich data set to compare to and look to, and I think that that really becomes important when you start talking about how at the end of the day, real estate is a cyclical business. Some cycles or some parts of a real estate cycle are similar cycle to cycle. Some parts are different. So I think that that's really helpful to have. I also think that there's been, understandably, and this isn't unique to RealPage, but I think that there's been this big shift towards artificial intelligence, and I think RealPage is in a unique position based on, again, the depth of some of that historical data that we have, but also, expanding beyond just data and analytics, you look at the other components of the business, the real estate business that is that RealPage touches. It looks at operations, it looks at management, it looks at utilities, it looks at smart building. There's so many different components of multifamily real estate and single family real estate to some degree that RealPage services that I think it's a nice differentiator to be able to cut from so many different components of the entire property stack as opposed to being hyper focused on, well, this is going to be one point solution that solves a issue that focuses on this component of the business. Hopefully that makes sense.
So, Carl, we see your great record cover collection
Oh
over your
yeah.
shoulder there. We've talked about that in the past as well. Your aspiring DJ career, your nice tie-dye mug there. You and I get along very well on some things, it seems. So besides adding to your record collection, what keeps you up at night these days?
Probably my 15-month-old, probably still working through that. I say that somewhat joking, but somewhat serious. I think the big thing that keeps me up at night, excuse me, a big thing that keeps me up at night these days is how much more difficult it is to make sense, not necessarily of the economic data, but the quality of that data and the quality of the inputs. We've seen that the census is, I don't envy the job of the census or the BLS and trying to collect data via surveys today the way that they have in recent decades, because survey response rates are just down. There's just so many other considerations today that weren't in place there 10 years ago that again, we're fortunate that we have a lot of data that we can look at here at RealPage, but what keeps me up at night is accessing some of the government data and some of the third party data, not necessarily accessing it, but just the confidence in that data, because it's just become a lot harder to collect.
So, if somebody fast forwarded to the end of this conversation and didn't want to listen to 49 minutes of you and I going back and forth, give me the TLDR top bullet points to walk away from this conversation.
This is where AI is super helpful. We have AI probably, we should have had AI listening in on us and ask us to wrap it up. But I would say that, I think the apartment sector is slowly but surely turning a corner. I don't think that we're going to see performance boom overnight, but I think that the market is probably in better shape today than it has been at any point in the past 36 months. A lot of that is informed by alleviating supply pressure. We've seen that demand is relatively resilient. I actually loved your talking point there on the transaction market, that the environment for property trades is very ripe. I think that there's a lot of appetite out there for apartment transactions, and I think that that serves as kind of a good proxy for investor sentiment on the space. Our demand and kind of fundamental data shows that things are improving. There's still some concerns out there. I think some of the concerns are going to be very market specific, but I think more so if I were to zoom out, the biggest concern is again just the degree to which policy effects or legislative impacts change management and ownership of apartments, and do we see any policy uncertainty in the coming few years? Hopefully we do, but I think uncertainty has kind of been the unfortunate. If we summarize the cycle in one word, I think unfortunately that cycle would be summarized by the word uncertainty.
You know what they say, Carl, the only thing that's certain is uncertainty. So
Yep.
I want to give you a plug because the RealPage Analytics blog is literally one of the first websites I go to every single day to see if there's anything new. The reason being the Insights blog, and I have it up on my screen so I can make sure I sound smart here, has 5 different tabs. And pretty much every single day, one of these tabs is being updated with a new story. Research and trends, local markets, student housing, sorry, 6 tabs, supply trends, demand influencers, and insights. If you aren't familiar with the RealPage Analytics blog, I highly suggest you check it out because there is just fantastic information there that it's free, it's easily digestible, and it's a really good data source for everything that's going on out there. Carl, on behalf of myself, the entire Hoya Capital audience, the viewers that are watching this today, tomorrow, next week, next month, next year, I can't thank you enough for spending an hour with us, sharing your wisdom and knowledge about all things apartments. And I hope that when we speak again and do this again a year from now, that we can look back and say, told you so. We told you this was coming. Here it is. So I hope it plays out the way that we see it. But best of luck in your aspiring DJ career. And we really appreciate you talking with us today.
Yeah, of course. We'll appreciate the opportunity and always good to stay in touch.